mistake most people make when refinancing has nothing to do with rates. It's focusing on the monthly payment savings and completely ignoring how long they'll actually keep the home. And that one mistake can quietly cost you thousands of dollars and maybe even the ability to sell at all later. Refinancing isn't good or bad by default, it's situational. Strategy matters more than rates or even how much you save per month, especially if there's any chance you'll move again. Here's the pattern that causes problems. Someone refinances, rolls $2,000 to $5,000 of closing costs into the balance of the loan, and saves maybe $200 a month. On paper, looking at your monthly budget, that feels smart. In reality, when that next move comes, the math can say otherwise. I promise this math is easy to do. Just take your total refinance costs. They're there, they just may be hiding in the higher loan balance. Then divide that number by your monthly savings. Even on the low side of costs, if you rolled $3,000 into the refinance and you're saving $200 a month, you need to stay in that home without another refinance for over 15 months just to break even. Move before that and you didn't save any money. Refinance to an even lower rate before that and those costs compound, so you didn't save any money at all. When you sell, that money comes directly out of your pocket because the loan is paid off before you take your proceeds from the sale. In slower or flatter markets, that higher loan balance matters more than people expect. It can be the difference between selling cleanly or feeling stuck when it's time to move because you can't sell for enough to cover everything. This is especially important for VA sellers because military members and even veterans are statistically more likely to move more often. Refinance decisions directly affect net proceeds. When equity is tighter, even small pricing or concession decisions can determine whether a home sells smoothly or stalls. When stall happens, people often start looking for market conditions to blame without realizing the refinance quietly changed the math. Wait, there's VA-specific piece about refinancing people don't realize until it's too late. Once a home has been converted to a rental property, you generally can't refinance it using a VA loan. At that point, the smarter long-term strategy is often to wait, build equity so that you can refinance into a conventional loan without PMI. Then you can free up your VA entitlement for your next purchase. For VA buyers and sellers nationwide, refinancing decisions affect more than monthly payments. VA loan refinancing entitlement availability and local market conditions all play a role in whether a refinance supports or restricts your ability to sell or buy again later, especially in markets where appreciation is slower. I see people attach ego to their interest rate all the time. The truth is, refinancing can't be about chasing the lowest rate. It has to be about answering a few honest questions. How long will I realistically keep this home? What does this do to my flexibility? And does this decision support or restrict my next move? Refinancing can be a powerful tool when used smartly, but when it's done without a clear plan, it can quietly steal your options. Before you refinance, answer this one question honestly. Will I stay in this home long enough for this decision to actually benefit me? If the answer isn't a confident yes, the refinance isn't saving you money. It's quietly limiting your future options.